Hey, good afternoon. This is Jerry over at Wealth Dynamics. Wanted to give you a really quick webinar today on the sacred account. So really quick, I want to share my screen and I want to talk to you about the breakdown of the sacred account and how this thing actually works, okay? So a lot of times with the sacred account, I'll talk to people and they'll say, hey, this looks awesome, but also it's a little confusing. I don't quite understand it. And so what I want to break down for you today is exactly where the money goes when you put it in a sacred account. Okay, so we're going to keep this short and sweet. A sacred account is a life insurance policy. It's got a high early cash value structure. It's going to be something you use for mid to long-term savings for the sole purpose of investing for cash flow. So this is not money you're using to buy a car. It's not money that you're going to purchase a home with. It's not money you're paying your bills with. You're going to use it for investing for cash flow or debt consolidation. One of the two items, right? So here's what I want to break down for you. If you put $1 in your sacred account, and I want to get my annotator going here. So if you put $1 in the sacred account, what does that actually look like? Right, that's the question that ultimately comes up. What is that dollar actually going to do for us? And so essentially, we have our dollar here, right? We're putting that inside the sacred account, and we've got to ask, all right, where's that dollar going? Okay, am I keeping that dollar? Is that dollar going elsewhere? Where is that dollar actually going to, right? And so I want to give you kind of the breakdown. If you put $1 in the sacred account, 30% of that dollar, or 30 cents on the dollar, is going to purchase your death benefit. Okay, it's going to purchase your death benefit, and essentially that money is going to be invested in actual death benefit in the company, which is treated like an equity share in the insurance company. So you own what's called a base death benefit in a whole life insurance policy. That base death benefit is treated by the whole life insurance company, which is a mutual company, like a share of ownership, meaning they're going to pay you dividends. Okay. Now, where did the other roughly 70% go to? The other 70% went to the cash value. Okay, the cash value is the liquid money that's available for use. It's money that you can borrow against today, immediately, right? So you've got that initial 30-70 split going into your policy. Now, once that's done, what happens next? Your death benefit here produces a dividend. Okay, so it produces a gross dividend income. Typically, that's going to be about 6 to 8%. And essentially, that's going to be your gross. All right, your cash value, the other 70 cents, gets credited the net dividend income, which is going to be your gross minus your reinvestment or cost of insurance. And that's going to basically get credited to the cash value itself. Again, that dividend is being produced by the death benefit after you've reinvested it into, again, death benefit costs, paid up additions, and whatever other bells and whistles you may have on your policy. Now, most policies don't need all of the extras. They just need, a basic base death benefit with the whole life insurance company, a paid up additions rider, and in some cases, a term insurance rider as well. Okay. So again, to recap, you've got 30 cents going to your death benefit. You've got 70 cents going to your cash value. That 30 cents purchased your death benefit, which is an equity share in the company. Your 70 cents here is going directly into your cash value that's liquid and available for use. Because you had the 30% or the 30 cents go towards your death benefit, you have dividend income. Okay, so I want to stress for you, if you did not purchase death benefit, you would have no dividends. Okay, so with no death benefit, you also have no dividends. So if you're like, hey, I don't want to own any death benefit, realize the death benefit's kind of arbitrary. We're not buying a policy because it has a death benefit. We're buying a policy because it's a good place to put money. And the death benefit is actually what produces the dividend. The way that I like to relate this is kind of like buying an income property. Okay, so if you buy a property, you're going to have money that goes into the property, and that's going to be principal. And then you have money that's going to go into the property, and that's going to be available equity. Okay, the equity is the money you can pull against. The principal you can't touch. Obviously, that's going into the actual loan pay down or the value of the property. It's not liquid. It's not accessible. Obviously, your equity is, and so you can pull against the equity right away. Okay, nobody says, I want to own as little home as possible. You still want to own it, right? But you're saying, I want equity. So that's the same thing with your policy. Okay, so you want to own the policy, and you do want to have as little death benefit as possible, but not to the degree that it's getting rid of your dividends. At the point you don't have a dividend or your dividend is suppressed because of the small amount of policy you actually own, you're actually losing, right? You're not going to see the growth on the policy. Now, the 70%, this is cash value. In and of itself, it's not going to just grow. Okay, it grows because the credit rate of that dividend. Okay, so you have your gross dividend. Again, you're covering the gross dividend is coming from the policy. It's going to get reinvested back into the policy. You're going to have paid up additions, PUAs. You're going to have your expenses, right? Because you do own insurance. That's like the maintenance cost, right? And the net of what's left over after you've reinvested is going to get put into your cash value and credited to it as a net dividend payment. All right. Now, the next thing we're going to see here is further stages of the policy. Okay. So the policy will continue to grow. It's going to continue to grow. You will continue to produce a dividend. You will continue to reinvest that dividend. You'll continue to produce a income on top of your cash value as a crediting system. And on the cash value side, the cash value will continue to earn the net dividend income tax-free, even when the money is loaned out. Okay, so even when your money is loaned out. So what this looks like is if you're earning a 6% dividend, for example, and you're borrowing at 5% interest, because you borrowed, you're still earning that dividend. Okay, so you're still earning the gross dividend. You're still getting the full growth on the policy as if you never took the money out in the first place, right? So that's the real win on a cash value policy, or a sacred account, as I like to call it. And the big thing you're doing here, again, is you're using this to invest in either income producing assets. The reason being is when you get your borrow, right, you pull the money out as a loan, you borrow it from the policy, you've got money outstanding, and you're going to take the cash flow and pay off that money outstanding. You're going to pay your loan back with your cash flow, okay, from whatever deal you did. So that's why you invest in cash flowing deals. The other thing you can do is you can pay off debt. Okay, so if you pay off debt on the policy, you now have money freed up from that debt, and you can use that old debt payment that's now free to pay your policy back early and basically pay your loan back, avoiding interest. All right. So guys, this is the simple breakdown of the sacred account. Again, if you have any questions on this, feel free to reach out to me. If you want to learn more, I want you to go to sacredaccount.com. Okay, that's sacred account. As you see here, sacredaccount.com. Okay, that is my site. That's going to give you plenty of information on how the sacred account works. If you want to get more questions answered, feel free to reach out to me. You can reach me at jerry@wealthdynamics.com, or you can hit me up here on Facebook, Instagram, YouTube, all of the channels. You can also go to our website, sacredaccount.com, and check out the contact request form there. And guys, we did just release brand new news. We did just release the Sacred Account Lite. Okay, so typically with our sacred accounts, we recommend obviously starting one up. We have a minimum of $500 a month. That's our normal. So if you don't have $500 a month in the past, we've not been able to set up an account for you. We have gotten some carriers set up that will do a different policy design, allowing us to go down to a minimum of $100 a month. Okay, so if you have at least $100, you can set up a sacred account. There's no reason you can't. There's no reason you shouldn't. This is better than putting it in a bank. This is better than putting it in a retirement account. It's better than putting in your 401k. So guys, again, check out sacredaccount.com. Thank you for tuning in. I hope that this video is valuable. I hope it gave you a better understanding of where the money goes in your sacred account. Make sure you like, share, and subscribe. Have a terrific day, and I will talk to y'all next time.